you are converting the Great Britain pound to the US dollar, right? So we all have probably seen this, right, at the airport or whatnot. It's basically like a currency exchange booth. So you go from UK, you go from London, and then you travel to the United States. Maybe you go to New York or something. And in that case, you cannot be using the currency that you use in UK, which is pounds, in US, right? You have to convert the pounds into US dollar. So you would usually go to this currency exchange booth and tell them, hey, I want to convert my pounds to US dollar. And then they will give you a certain exchange rate, and then that is when you are able to convert however much pounds that you have into US dollar. Now, when you do that, when you convert your pounds into US dollar, you are essentially participating in the Forex market, right? So, yeah, you probably have been trading Forex without even realizing it. As long as you have traveled to any other countries other than your own one, then you have participated in the Forex market. So Forex markets are always quoted in currency pairs. The base currency is on the left of a currency pair, while the quote currency is on the right. The base currency is always equal to 1, and the quote currency is always equal to the current quote price of the pair. So this means that the price of the pair, in this case EURUSD, the price of the pair is this one right here. It's basically stands for how much of the quote currency it costs to buy 1 unit of the base currency. So when you trade Forex, you are essentially buying one currency while selling another. Let's look at this example that we have right here. For example, EURUSD equal to 1.35361. So in this exact scenario, Euro is the base currency, right? Because it's on the left. USD is the quote currency because it's on the right. And what it means here is that it would take 1.35361 USD to purchase 1 euro. Okay? So, once again, if you go Google and search, let's say you want to convert euro to USD. So you search euro to USD in Google, and it will probably come up with like a graph that looks something like this. And what we have over here, this is a graph that actually displays the fluctuations of the exchange rate. So you can see 13 May, on the 3rd May, it was probably only 1.08, and then right now it's like 1.09, right? So it actually increased over the past few days or so. So in this case, when you see this right here, this basically means what? The EURUSD is equal to 1.09. So it takes 1.09 US dollars in order to purchase 1 euro. Now, when you buy Euro USD, you expect the price of euro to rise. So you buy euro, which is the base currency, and you sell USD, which is the quote currency. Now, if the euro strengthens against the US dollar, which means the euro goes up, right? Guess what? You make money. Now, when you sell EURUSD, that means you are expecting, or rather you're forecasting, that the price of euro is going to fall. So in that case, you will sell euro, which is the base currency, and you buy USD, which is the quote currency. So if the euro actually weakens against the euro USD, right, it actually goes down, then guess what? You make money. So this is essentially how Forex trading actually works. Now, for one currency to go up, there will be another weakening against it. The rule of thumb is that all currencies cannot go up at the same time. Just think about it. It's basically the economy of a country, right? The currency basically stands for the strength of the economy of a particular country. So it does not make sense for all currencies to go up at the same time. There is always going to be a winner and a loser. That is just trading in general. Trading is a zero-sum game. That means if one currency is going up, the other one, the quote currency, is most likely going to go down, right? So same thing in trading. If you win, that means someone out there is losing. If you lose money, that means you're essentially transferring your money to someone out there, the winner, right? So Forex traders actually weigh up whether a currency looks likely to strengthen or weaken against another. Then they trade that pair accordingly. Now let's talk about who actually trades Forex, right? There's a few groups of people. The first one is what we have, the big banks. You know, the investment banks, basically the big financial banks. And we also have your large financial institutions, like your hedge funds, your JP Morgan, basically all the big banks out there, as well as, your hedge funds like the Soros Fund, even Warren Buffett's Berkshire Hathaway. Basically all of these large financial institutions and big banks, they trade Forex, right? They actually manage like pension funds or investment funds, and in that case, they're going to use Forex to kind of hedge it, right, and trade with it. And then we got central banks and government. These people are very important when it comes to Forex because they are the ones that actually come up with the policies, right, to actually determine the supply and demand of a currency. And when they do that, that determines the price of where the market is going to go, or where the currency pair is going to go in the long term. And then we got large commercial companies, right? Just think about it. Large commercial companies, they might have employees overseas. In that case, when they pay their employees, they need to convert the salary to their employees' country's currency, right? So, yeah, another example could be, when you purchase something from the large commercial company. So let's say right now, example, I'm in Singapore and I want to purchase something from Amazon in the US. In that case, I go to, I saw this book that says that it's $20, right? $20 book on Amazon, so I purchase it. When I do that, once again, Forex comes into play because my currency is SGD, Singapore dollars. So I have to, in order to purchase that, the bank or rather Amazon will automatically convert the 20 USD into SGD so that I can pay them with SGD and then they will convert the SGD back to USD, right? In that case, guess what? I've just essentially participated in the Forex market as well, right? So large commercial companies, they participate and trade Forex as well. And then there's the small fishes in the ocean, which is us, which is retail traders, which makes up like the smallest trading volume among these other groups that we have right here. So based on this, big banks, large financial markets, these are what we call smart money, and they are the one that actually controls the market, and they are the ones that's actually able to manipulate the market, so to speak, right? So that is why as retail traders, we understand that we have no buying or selling power that is big enough to actually move the markets. So what we can do as retail traders is that we can only try to trade with them rather than against them. That's the only way to actually make money in the markets. Now, how do you determine whether a currency pair is going up or down? How do you know when to buy or when to sell? How do you know that the market is going up or down? How do you predict where the market is going to go? The truth is, as retail traders, we can't predict where the market is going to go. And we don't have to do so in order to make money. Because trading is simply a probability game, which means that every trade outcome is random. No matter how confident you are on a trade, it's always a 50% chance that you're going to win the trade and a 50% chance you're going to lose the trade. However, what we can do is that we can increase the probability of us winning a trade by developing what I call an edge. An edge is what separates winning traders from losing traders. You see, the thing about beginner traders is that most beginner traders, they don't have an edge, and as a result, they are not able to make consistent profits. Yes, they might make some money here and there, but they will always find it incredibly difficult to profit consistently. But as they master the 3 M's, which I'm going to go through soon, and start to focus on the process rather than the outcome, that is when they will transcend from the randomness of the market and start to make consistent profits. Your trading strategy that helps you make more profits than losses. As simple as that. So, in order to develop your edge, you need to master what I call is the 3 M's. Right? So, the first M is method. You need to have a profitable trading strategy that works in every market condition. The second M is money management. Right? You need to know how to preserve your capital so that you can actually grow your trading account rather than blow it and lose your money. That means you need to learn how to take trades with high risk to reward ratio while keeping your risk consistent. And then lastly, you got your mindset. which is where you need to learn how to actually control or rather manage your emotions when you are trading your live account, right? Especially when you have your hard-earned money on the line. You know, all your emotions will start coming into play, your fear, your greed, your FOMO. All these emotions are going to cause you to take stupid trades and make stupid decisions. And there's a saying, trading currency pairs. So these are essentially like your best friend. Now let's talk about what are the different types of currency pairs and which one should you trade. Firstly, you must understand what are currency pairs. Currency pairs is basically a price code of the exchange rate for two different currencies traded in the Forex markets. All currencies are identified by their own ISO currency code. Here's what I mean. When you see currency pairs like GBP, GB stands for the Great Britain and P stands for pound, which is the currency for the Great Britain. So you can see all these currency pairs, right? If you look at their name, their ISO currency code, it shows you the country and the currency. And once again, another example, JPY, the Japanese yen. And you can see the first two letters is the country, which is Japan, and then the third letter is currency, which is yen pair. And then lastly, once again, the standard best friend of every Forex trader, the US dollar. You can see US, United States, the first two letters, followed by the United States dollar, which is the currency. That is why it's called USD. So basically, all currency pairs are identified by this personal ISO currency code, so that every single trader, when they look at a currency pair, they know exactly what they are trading, what country is this currency pair from, and what is the currency that this guy is actually trading. Now let's talk about the different types of currency pairs. Firstly, you've got the major currency pairs. Major currency pairs are basically pairs that include the US dollar. Things like your Euro USD, GBP USD, NZD USD, USD JPY, USD CHF. Now, if you're not familiar with this, this is basically the Euro USD, Great Britain pound against the USD, New Zealand dollars against the USD, Japanese yen, and then US dollar over the Swiss franc. So these are basically the main currency pairs inside the Forex market. What this means is that these major currency pairs, they have the most amount of liquidity, right? That means most people are trading these major currency pairs. They are like the most commonly traded pairs. This means that the market tends to present us more trading opportunities when it comes to the major pairs. USD CAD, I almost forgot this, the USD against the Canadian dollar. Now let's talk about minor currency pairs. Minor currency pairs are basically pairs that include any two of the major currencies except the USD. So basically, minor currency pairs is basically any of the major currencies like your Euro, Great Britain pound, NZD, JPY, CHF, Canadian dollar. Any two of these major currencies, you combine them together, you get your minor currency pair. And every single minor currency pair, there is no USD inside. It excludes US dollar. So, example, Euro JPY. Euro, a main currency pair, JPY, and also a main currency, another major currency. And then you got Euro CHF, Euro Swiss franc. And then you got GBP AUD, the Great Britain pound against the Australian dollar. And then you got GBP JPY, Great Britain pound against the Japanese yen. And then you got Australian dollar against the Canada dollar. And then once again, AUD against the Swiss franc, the Australian dollar against the Swiss franc. Lastly, you got the exotic pairs. These are the pairs that is dangerous. This is the ones that we don't trade, alright? Because why? Nobody trades them. First of all, nobody trades them. And second of all, there's extremely low liquidity and low volatility since nobody is trading them, which means price tends to go crazy when like a news event come out or whatsoever. So these are basically the pairs that include one major currency pair and another currency from emerging markets like Africa, Thailand, what else? Mexico, basically from emerging markets. So it's example like USD SGD, the United States dollar against the Singapore dollar, or the United States dollar against the Thai bahts, and then Euro against the Hungarian dollar. I think that's the Hungarian currency. I don't know what's that. And then you got the Australian dollar against the Mexican peso, and then there's Canadian dollar against SGD. So all of these are examples of exotics. As much as possible, we try to stay away away from exotics, because let's be honest, you're not going to make any money from trading exotics. And if you're not going to make any money from trading exotics, what's the point of actually going through them, right? This is just for you guys to understand that these things exist. These exotic currency pairs exist, right? But for you, just stick to what's work, which is either the major currency pairs or the minor currency pairs, which will present you much more trading opportunities. Next, which currency pairs should you be trading? That's the million-dollar question. I would advise you, if you are a complete beginner, which I believe you are since you're watching this lesson, stick to the major currency pairs. Major currency pairs like what? EUR-USD, GBP-USD, NZD-USD, USD-JPY, USD Swiss franc, and USD Canadian dollar. The reason why I ask you guys to stick to these major currency pairs is because these currency pairs have a lot of daily trading volume, right? And they are the most commonly traded currency pairs in the world, which means that they're going to give you sufficient trading opportunities, right? Especially if you are a beginner, you will start to see a lot more trading opportunities as you begin to level up in trading, right? And these are the major currency pairs they can go to. Now, the good rule of thumb that I always tell my students, and what I do myself, is that I will always stick to 1 to 4 currency pairs. Right here you can see this is my watch list right now, and this is what you should not do at the start of your trading journey, right? At the start of trading journey, I will absolutely just ask you to focus on mastering 1 to 4 currency pairs max, right? 4 is like the maximum number. That's like, you should not go more than 4 if you are a beginner, right? And it's always going to be better if you become a master of one rather than a jack of all trades and master of none, right? So I'll advise you, if possible, focus on mastering 1 currency pair. And maybe the reason why I want you guys to have at least like 3 currency pair inside your watch list is because if that 1 currency pair does not provide you with trading opportunity on that day, you can look at trading opportunity from the other 2 currency pairs, right? So yeah, stick to 1 to 4 currency pairs. And the reason why I have like 7 currency pairs right now on my watch list is because I'm a trader, right? I've been trading for 4 years now. I know exactly what I'm doing, and it's much more easier for me to analyze the charts and actually come up with my buyers and stuff. And right now the thing is, I don't even like really trade all of them. You see, what I do is that I put like a red flag beside the currency that I believe that there's going to be an upcoming trading opportunity, and that's the one that I'm concentrating on. So if you look at this, I'm only concentrating on like 2 currency pairs, which is GBP-AUD and NZD-USD currently, because I believe that there's going to be an upcoming trading opportunity. So like I said, focus on maximum 4 currency pairs and you'll be good to go. Now, in order to become a Forex trader, you have to understand the way we speak. You have to understand the terms inside Forex trading. And that is when I want to teach you guys the Forex language and lingo. This is like somewhat like a dictionary for you guys to understand the terms that is commonly used inside Forex trading, or rather used by Forex traders. Firstly, what we have is pips. Pips is basically what I call, or rather no, not what I call, but what is called percentage in point. It basically stands for the amount of change in the exchange rate of a currency pair. A pip is the 4th number after the decimal point. So 1 pip is equal to 0.0001. So if you look at this currency right here, EUR-USD, right now its quote price is 1.0926. In this case, the pip will be the 4th the decimal point. So this is the decimal point, 1, 2, 3, 4. There we have, that is your pip. Right, so over here, right now, this is the pip. So it's basically the 4th number after the decimal point. So if this goes from 1.0926 to 1.0927, that means it increased by 1 pip. On the other hand, if this goes from 1.0926 to 1.025, that means it decreased by 1 pip. Now, let's go through a few examples. So in this example right here, price went from 1.2468 for EUR-USD to 1.2470. In that case, you can see price just increased by 2 pips. Okay, and then another example right here, price went from 1.2576 to 1.2566. Price just went down and fell by 10 pips. Remember how you get this 10 pips is you take this 76 minus 66. You get 10 pips. Over here, 68, 70 minus 68, you got your plus 2 pips. And then last example right here, 1.2176, and it increased to 1.2276. In that case, you can see this right here went from 176 to 276, so it's basically plus 100 pips. Right, so as time passes, you will start to familiarize yourself with this concept of pips. Right, this is essentially like how we used to measure the change in the exchange rate of a currency pair, and it also allows us to measure our profits or loss. Now, for Japanese yen pairs, it's a little bit different because Japanese yen pairs only go up to 2 decimal places, right? So Euro USD, all the major currency pairs, all the minor currency pairs, they have like a string of numbers like this, right? But Japanese yen currency pairs, they only go up to 2 decimal places. So you look something like this, 170.67. In that case, 1 pip is the second decimal place, the number in the after the, how do I say this? The second number after the decimal point. So in this case, the second number after the decimal point is this one right here. So this one right here is your pip for Japanese yen pairs. So if price of Euro JPY go from 170.67 and it increased to 170.68, then guess what? Price just increased by 1 pip. If price goes from 170.67 to 170.65, price just decreased by 2 pips. Now, there's also this thing called your pipettes. Pipette is basically micro pips. It's 1/10 of a pip. So a pip is like the 4th number after the decimal point. A pipette is basically the 5th number, right? So in this case, usually, if you go to TradingView or your broker, you will see that the currency quote price looks something like this, right? The string of number that we have right here, and then there's like this small little number right here on top of like basically the pip. Yeah, on top of the pip count, there's this small little number. In that case, that is the pipette. So right here, this is the pipette, and if price goes from 1.09263 to 1.09265, you can see the pipette change, right? So 3 to 5, this means it just increased by 0.2 pips, right? So 1 pip is basically 10 pipettes. So it's like 0.1 pip is this number right here, right? So if price goes from 1.09263 to 1.09265, that is plus 0.2 pips. Now, lot size. Lot size is basically the size of your position, or rather how many units are you buying or selling of a particular currency pair, because Forex is traded based on lots. Now, there's 3 types of lot size. First one is the standard lot, the biggest one, and that is when it's what is called one lot, right? It's like a volume, 1 lot. In that case, that means you are either buying or selling 100,000 units of that currency pair. So if you are buying 1 lot of Euro USD, that means you are buying 100,000 units of Euro USD. And that means every time price increase by 1 pip, you are making or losing $10. And every time price move by 1 pip, that is $10. Okay, then next, there's the mini lot, which is your 0.1 lot. In this case, you are buying or selling either 10,000 units of Euro USD or GBP/USD, right? In that case, every time price move by 1 pip, it's only a $1 increase or decrease. And then lastly, you got your micro lots. That is your 0.01 lot. That is the smallest lot size that your broker will allow you to trade with. In this case, you are buying or selling 1,000 units of Euro USD or whatever currency pair that you're trading once again. And this time round, whenever price move by 1 pip, it's only moving 10 cents, which is $0.1, right? So that is your lot size. Now, I want you to make sure that you really familiarize yourself with these terms. Firstly, bullish. Bullish means that you are expecting price to increase. Bearish means that you are expecting price to fall. So if I say that I'm bullish on Euro USD, that means I'm expecting Euro to go up in price. If I'm saying that I'm bearish on Bitcoin, that means I'm expecting Bitcoin to go down in the near future. Long means buy, short means sell, right? As simple as that. So if I say that I'm longing Euro USD, that means I'm buying Euro USD. If I say that I'm shorting Tesla stock, that means I'm selling Tesla stock. And then stop loss. Stop loss is basically a preset price where your broker will automatically close your open trade, your open position, if the trade does not go as planned. Right? So when this happens, it protects your capital and it prevents you from losing more money than you want to lose. And then your take profit is the profit goal that closes the trade if the trade do go as planned. Right? So if you manage to win the trade, that means that price has most likely hit your take profit, right? Price most likely hit your take profit and you got out at the goal that you set out for yourself for this trade to play out. In that case, the trade went as planned, it hit your take profit, you make a profit, right? Then stop loss is basically the opposite. So if the trade does not go as planned, the broker will automatically close the trade at a preset price and prevents further losses. So now, I'm going to show you your new best friend for the next 5 years or 10 years or however long you plan to trade. And it's this beautiful software called TradingView. So go Google, search TradingView, right? And click on the first link right here, TradingView Track All Markets. This is basically your analysis platform. This is where you actually do your analysis when it comes to your charts or whatever you're trading, be it crypto, stocks, forex, futures, whatever you're trading, you're going to be analyzing your charts here. So like I said, this is going to be your wife, your new wife, or new husband for the next few years or so, right? So make yourself comfortable. So first thing first, when it comes to this website, it probably looks something like this. Don't know if it's the same guy or not, but it looks something like this. So just go to products, and then you probably see something like this, or maybe you can just explore around here. There's even like the community that they have right here. And then you can see the different sort of stuff that you can trade. You got stocks, you got ETF, you got crypto, forex, indices, futures, bonds, even about the economy, some stuff about the economy. There's news as well. And these are the brokers that's integrated with TradingView. And then, there's more stuff right here. So just go to product and just go to super charts. This is basically where you can actually get the charts. And then if you press this search button right here, you can search anything that you want to trade and it will appear. So let's say you want to trade Tesla stock. Tesla, right there, just click on it and then you can just launch the chart of Tesla. But in this case, we are trading Forex, so let's just search Euro USD. So I just click Euro USD. And bam, I will have the chart of Euro USD. Right, so when you look at this, all of this stuff right here, this is basically your Japanese candlesticks charts, right? So Japanese candlestick charts, I'm not going to talk too much about Japanese candlesticks in this lesson. This is just a walkthrough on how to use TradingView. Japanese candlestick lesson is the next one, I believe. So but basically, right here, this basically shows you price, right? All of these Japanese candlesticks help you understand who is actually in control of price, whether it's the bears, the sellers, or the bulls, the buyers, right? So that is basically the chart section. Just go through section by section with you guys. So maybe we start with the right hand side. So the right hand side, we have your watch list, right? At this watch list, you can just add whatever you want inside your watch list. You want to trade EURUSD, and then you want to add all your major currency pairs, GBPUSD, and then USD JPY, USD CAD, and then maybe even AUD USD, right? Just add all of these currency pairs, whatever you want, onto your watch list. So they can just focus on these few currency pairs. And if you want to remove any, just press this X button right here. Bam, it's gone. Right? And if you want to add, just press this plus button. No rocket science right here, right? Right, so once again, you can actually put like whether you want description to show or you just want the logo, the ticker, which most of you guys just select the ticker so it looks more clean. So alerts is basically where if you press this plus button right here, you can set an alert at a specific price point, right? So let's try it out. Press the alert button right here, and then let's say you want an alert that TradingView notify you when price crosses maybe 1.10, right? So 1.10, I want an alert, right? So you can choose whether you want it only once or every time price actually crosses 1.10, and then you can then choose what alert name you want. Maybe you want to put analyze Euro USD, right? So put that on. Once you created the alert, guess what? TradingView will personally send you a notification when price eventually reaches this 1.10 level. It will send you something like either a message or an email telling you that, okay, bro, your USD is at 1.10. You can start analyzing it or whatever you want to do with it. So let me just remove that. And then next, right here, this is the data window. It basically shows you all the data about the thing that you are trading, be it currency pair or stocks or whatnot. It shows you all the data right here. You can see the high, the low, everything. It just adjusts depending on your cursor. Yeah. So, and then you got this window right here, which shows you all the different sort of stars. Yeah, basically everything like US exchanges, all sort of stuff. I don't really use this honestly, so we can just ignore that. And you can see this is where you can even create your own ideas when it comes to the charts. You know, never really use this once again, but yeah, this is where you can actually publish your trade ideas, right? And then this is a chat function where you can actually chat with other people, be it in the Forex community or the cryptocurrency community or even the stocks community or whatnot, right? Or even gold, right? You can just have a chat with people, see what other people are doing, you know. Yeah, I wouldn't really recommend you guys to use this chat function because our goal is to help you become an independently, consistently profitable trader who's able to think on his own feet and trade independently without relying on other people. So yeah, I wouldn't really recommend you to use this, but if you're bored, you know, why not, right? And then this is other people's ideas, idea stream, other people's ideas. Right, once again, wouldn't recommend you to use this. I don't use this myself, and just, yeah, and then yeah. So yeah, that's basically for the right side. Now let's go to the left side. Right, no, actually let's go to the top. Right, so top right here, once again, this is a search button right here. It's the same thing. You search for whatever currency pair that you want to trade, just search right there, and then yeah, you can just, you know, whatever you want to trade, just search right there. And then right here we have your time frames, right? So over here, these are basically the time frames that actually you want to trade on, right? So whatever time frame that you're on right now, each candlestick represents that time frame. So if you're on the daily time frame, what this means is that each one of these candlestick represent 1 day. So this is 1 day, this is 2 days, this is 3 days, 4 days, 5 days ago, 6 days ago, 7 days ago, right? So basically, this is how the time frames work, right? So whatever time frame that you're on, the candlestick literally represent that time frame. So right here, this is the 4 time frame. You can see the time below or the bottom axis. You can see this is at 9 a.m. and then this is at 5 a.m. which is 4 hours ago, and then this was at 1 a.m. which is 4 hours ago, right? So basically that's how the time frames work. If you're on a 15-minute, same stuff, right? Each one of these candlesticks represent 15 minutes, and you can see right now this is 12 p.m. and then this was 15 minutes ago, which is at 11:45. This candlestick was formed, and then this is at 11:30, which actually created this candlestick right here. And you can see right now is actually creating a candlestick. It's creating the 15-minute candlestick, and you have the timer right here, which shows you how many minutes remaining up till this 15 minutes is up, and then the entire candlestick will be formed. Right, so we don't know whether it's going to be like something like this or something small or whatnot, right? We still don't know what's going to happen, right? We have to wait until this timer is up, wait for this candlestick to fully form, and that will be your new 15-minute candlestick, right? And then yeah, you can see these are basically all the time frames, right? Whatever time frames that you want to have on like your favorites right here, have it on display beside it, yeah, and you will have it. And then next right here, this is basically your different sort of charts, right? So there's bar chart, there is hollow candles chart, there's volume candles. Okay, this is a free version, right? This is basically another of my account. I have like the premium version, like the most expensive one, because TradingView was kind enough to sponsor me, right? But basically, if you're on a free one, yeah, you are limited to certain stuff, right? So yeah, you're limited to certain features, yeah. But you can see basically this is where you can switch all the different charts that you want, and some is like paid, like the volume one right here, yeah, like this one right here, which is really really cool, but it's paid, yeah, and you need to upgrade and stuff, right? So certain features are unlocked, but overall, this entire platform is free for you. But if you want additional features, then you can consider getting the paid one, right? So if you're just starting out, I'll just recommend you to just stick to the free one. That's what I did, right? Just stick to the free one is enough for you. And then indicator step right here. Actually, you can get whatever indicator you want. You can just search. Okay, I want RSI. And then RSI, boom, relative strength index, boom, indicator right here. Maybe I want a moving average. Then boom, moving average right here. Yep, you can see right there. But at 1% Club, we don't teach you how to use indicators, so just remove all that bullshit. Right, so next, this is your templates, right? You can actually save the indicator template and it will just appear right here. So like this, this, you know, it's like different templates basically. And then once again, the alert window, same stuff. And then there's a bar replay tool, which allows you to, go back in time, right? You can see, you can just go back in time and boom, you are literally back on April 1st. And then you can actually, you can see the price moving, which is really, really cool. You can change the replay speed, make it even faster, and then boom, 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 boom. It's basically like a time machine where it allows you to go back in time and then jump to present. Then there you go. So that's basically the bar replay. But the free version only allows you to bar replay on the daily time frame. So if you're gonna go down to like the 4-hour time frame and bar replay, it will require you to get a paid version. Right? You see right there. Yep. So yeah, that's basically for the top bar. And then before I move on to the left side, I want to talk about how you can actually change how your chart look like. So you press right click on the charts and then you press the settings, and this is where you can actually change your candlestick's color. Right? Maybe you want it to be blue. And then maybe you want the other color to be light blue, right? And then you can change the border color as well to blue and light blue, so that it matches itself. And then boom, yep. So you can see you just change your entire candlestick's color, and then you can also change like the grid, like the background, right? So if you don't really like the grid, not a fan of it, you want to keep your charts as clean as possible, you can just go here. You can change the grid lines to none. And you can even change the background color, maybe on black or I don't know, gray or yeah, whatever. Or you can even choose like a gradient color, which is quite cool. Choose 2 colors and it will look like a gradient thing. Yeah, so for me, I just stick with white most of the time. And then you can even add a watermark if you want of like the currency pair. You can see you just stay there forever. Yeah, and the rest of the stuff you can just go explore on your own. But basically that's how you actually customize your charts and really make it clean and make it really personalized. Once you're done with that, make sure you save it as a template, right? So just press template right here, save as. Maybe you want to put like the sea waves color, right? They just save it, right? You do this because like next time, for some reason your charts look like this again, then you can just press like right click, go to color theme, and you can actually change to the template that you actually save at, which is like this. Yeah, so that's basically how you do it. You can see that I have like different template right here, the red and blue one and YouTube one, and yeah, this is a normal one. Right, so yeah, that's basically how you customize your charts to make it your own. Once again, you must make yourself comfortable because like I said, this is going to be your best friend from now on. So might as well make yourself feel comfortable, make yourself home, right? And then let's go to the left side. This is where you will spend the most time on, right? This is where you actually get all your tools. So you got the trend line tool right here, which allows you to draw a line, which is cool. And then you got like I'm just gonna show you like the ones that I use the most. And you got horizontal ray tool right there. And then you got a horizontal line tool, right? Just put that in, horizontal line, and it just goes like, it's just like an extended line like this, and it just drags all the way across the charts. And then you got your Fibonacci right here. And then yeah, once again, I'm just going to show you the ones that I use because I don't really touch all of this stuff actually. Like most of these, I have never literally used it before, right? And then yeah, all this stuff, I don't really use it before, but I can just explore. I don't even know what this is. Yeah, some stupid pattern, ABCD pattern, right? Yeah, so. And then you can have your long position too, which actually like kind of forecasts, what price is gonna do. Place your stop loss, place your take profit. If you're entering for a buy, this will be a long position too, which will be very useful to actually forecast your risk to reward ratio. Or your short position too. If you enter for sell, place that there. Set your stop loss, set your take profit. Find out what's your, your risk to reward ratio right there in the middle. So yeah, that's the tools. And then there's another very useful tool, price range tool, which allows you to calculate the pips, right? So let's say I want to calculate what's the pip from here to here. Then I just drag it from this all the way up here, and then this last number right here, 125 pips. It basically tells me like how many pips move is this, right? So it's just 125.6 move. So it's very useful. It doesn't require you to manually go and calculate the pips. It just do the hard work for you. And then there's like a bunch of emojis right here. I don't even know why it's this emoji. And you can add a text, right? Say, hi, I'm Brett, right? Whatever you want. And you can double click on it. You can customize the color that you want, right? Make it bold or whatever, white or whatnot. You want to increase the size. Yeah, you don't want background, boom. Change the text color, boom. Yeah, you can just go and play on your own, right? You can add text. And then you can add a call out as well that says, okay, I want to mark this part. And they say, this is bearish candlestick or something like this, right? Something cool like this. Yep. And then the rest of the stuff, don't really use it. Once again, yeah, then this is where you can just remove all your drawings at once. So if you have like multiple drawings, you can just drawings, or you can remove all the indicators. And then this is where you can actually hide your drawings. So let's say like, you know, you marked up a bunch of stuff here, right? Mark up a bunch of stuff here, like let's say you got this, and then you got this, all this stuff right here. You press this, it just hides everything, right? Just your candlesticks alone. And then once again, if you want to remove all the drawing, just press this, remove drawings, right? And then yeah, the rest of the stuff you can stay in drawing mode right here, which allows you to keep on using the tool that you are stuck with, right? So which is really cool. And yeah, that's basically it. And then at the bottom panel, this allows you to connect to your trading broker, right? Only these brokers that you have right here, you see right here, these are the brokers that can actually connect to, right? So yeah, and then this is the strategy tester, which I don't really use. Pine editor, don't really use it, but you can explore on your own. But this is basically how I personally use TradingView, right? These are the tools that I have. And once again, before I forgot, this is the favorite tools bar, and if you want to add like your favorite tools into like this little toolbar thing so that it appear like this, you can just like easily access it like this, right? Whatever tool that you want, just easily access it, right? You need to go to the tool that you like and then just press the star button beside it, and then it will appear on this toolbar right there. Hey guys, so this is a tutorial on how to actually use MetaTrader 4 to actually execute your trades. First things first, you need to go to your App Store or Play Store or whatever you have on your phone and search MetaTrader 4. Right, this is the one that I use, MetaTrader 4. There's also MetaTrader 5, which is the more updated version. The software, the interface is a little bit different, but essentially the same thing, right? So I just like to use MetaTrader 4 because I've been using it for so long, and yeah, there's not much difference between MetaTrader 4 and MetaTrader 5. It's just that MetaTrader 5 is just more updated. It just looks much more updated. Right, so MetaTrader 4, once you download it, open it, and it looks something like this. Right, so first things first, you need to go and set up your account. So press settings right here, and then press this button right here. This actually allows you to add your live account or even create a demo account if you want. Right, so just press this plus button right here. So two options, either you log into your broker like a live account, or like open the demo account. So if you're practicing, you can open a demo account that will be trading with virtual money. It'll be like a fake money that you can actually play with and actually practice your trades. Now on the other hand, if you are ready to actually, you know, connect your broker, right, just press this button right here, and then you search your broker right here. Let's say you're trading Forex.com. Maybe like let's try Oenda right here. You can see, then you basically choose the live broker. Basically, if you sign up like a live account with your broker, it will show you the exact details on which one to choose and all that stuff. So yeah, choose one, yeah, and then basically the instructions will be inside the email that you actually sign up the broker with, right? So I'm not going to show you how to do it, but this is basically how you actually set up your live account. Just press this and then just go set up your live account, and then this is where you actually open a demo account. So right now I already have an account in place. This is like a live account right here. So just gonna walk through with you what we have right here. By the way, this is like an old live account. I didn't realize that I have like $1,000 in this account. This is from like 2 years ago. Yeah, this is like a spare phone. You can see this shitty phone. Anyways, so let's go through this. So first things first, when you go to quotes, this is basically where you get all your currency pairs, right? So all your currency pairs, it's like a watch list on TradingView. If you want to add currency pair, just press add button, and you can add like Forex currency pair. Just press this green plus button, and it will go to your watch list, right? So whatever you want to add, let's say you want to add some Euro JPY or something, just search, and then yeah, just add Euro JPY, add right there, and then it will appear here inside your watch list. Once again, this is something like a watch list. There's an advanced tab and there's also a simple tab like this. If you're a beginner, just stick to the simple one. So if you want to trade, right, just press the currency pair that you want to trade. Let's say I want to trade EURUSD, press trade, right? And the other one is, it shows the chart. If you press chart, it will show you the chart of EURUSD. Let's go through the trade first. And then if you press details, it shows you the details of, you know, the spread and the margin and the other stuff, the swap and all that other stuff, right? So let's say EURUSD, let's press trade. Okay, so when it comes to here, this is basically where you actually execute your trades, right? This is where you actually place the buy or sell order, right? So this is the price that you'll be buying at, and this is the price that you'll be selling at. And then this is basically where you input your lot size, however much lot size you want to use. You want to use a 1 lot, a standard lot, or you want to use a micro lot, or 0.5 lot, or 0.26 lot, 0. Whatever lot that you want to use. This is where you actually input it, or even the smallest lot that we have right there, right, micro lot. So that is basically how you choose the lot size, right? You can even do this on these buttons right here. So this is where you put the position size, and this is the currency pair that you are trading, and this right here, it shows you what type of order you want to actually enter for. Market execution means the moment you press the buy or sell button, you will automatically get into the trade, right? You will literally, your trade will be executed on the spot. However, if you want to have like a buy limit, sell limit, or buy stop, sell stop order, this is what it means, right? I'll just show you on the computer. So buy stop, sell stop is something like this, right? Something like this. So a buy stop is basically an order placed above price and price keeps going up. So if price is right here and you place a buy stop at this area right here, when price eventually get all the way up there, your buy stop will be triggered, and then your broker will automatically get you into the trade. And then a buy limit is basically, you want to place an order below where price currently is. So once price get below to that price, your broker will automatically get you into a buy position, and yeah, that's basically a buy limit. And a sell stop and sell limit is the same thing, it's just that in this time, instead of buying, you are selling. So sell stop is basically an order placed below price and price keeps going down, and sell limit is order placed above price and price then goes down. Alright, so back to the MetaTrader 4 that we have right here. So that's basically what it means to have buy limit, sell limit, buy stop, sell stop order. Yeah, and then this is basically where you place your stop loss. Whatever price that you're right there, 1.085 or whatnot, 1.782, and then you can place your take profit, whatever you want to put here and stuff. And then once you're ready, place your stop loss, place the take profit, then you'll press either the buy or the sell order. I'm just gonna maybe try out, give you like an example. So let's use like let's just put like a random as lot, stop loss 1.089, 1.08, and then put like a take profit at like 1.09 and then press over buy. Yup, so that is basically how you actually execute a trade. And bam, you're inside the trade, you know. And then this is where it will show you this screen right here. This is your basically where you actually monitor your trades. After you execute your trades right here, go here, then this is where you actually monitor your trades to see whether your trade is right. Modify your stop loss, you know, maybe you place your stop loss wrongly, modify it, and boom, modify it, update it. And then if you want to close the trade, press this tick button right here. You can see this tick button, press on it, and you can see you can close the trade right here, right? You can close with loss. Yeah, basically if you press the button, it will close the trade. Right, before we do that, let's just show you some other stuff. Yeah, you can also add on to your existing position. Just press this plus button and you can actually enter for another trade on Euro USD as well. And then once again, this is the chart button, and this is the next thing that you want to look at. Before that, just a quick run through on this. The balance is basically how much money you have in your trading account right now. Equity is basically how much money you have in your trading account, your balance, plus your floating loss or profit. Right, and then margin, free margin, and margin level, all this other stuff, right? I will get through it inside another lesson. But basically, these are additional stuff that I personally don't really look. I mean, you don't really need to look at it, right? Basically, this is more on leverage and stuff, right? Which we'll run through soon. But these are all on leverage and stuff. But right now, you just need to understand that balance is basically how much money you have in your trading account, and equity is basically your balance plus your floating loss or profit, whatever that you have right here. And over here, this basically shows your floating loss and profit, right? So right now we are negative 0.08. So chart here, once again, chart, I believe there's nothing much to say about chart. It's pretty much quite similar to trading view. You can also add your tools right here. You can have a cursor here. You can add indicators here. You can add freaking lines here. Yeah, basically whatever you want to do, it's like quite similar to trading view. Yeah, you can see you can add a vertical line, right, and boom. Yeah, you can just have fun with this, and then you can adjust the time frame, 5-minute time frame, 4 hour, 1 hour, so on and so forth. Yeah, so this is something like trading view. I personally don't like to look at the charts here because I don't really like the way that it looks. That is why I prefer to actually, you know, execute or rather analyze my charts on trading view itself, and then once I'm ready to place a trade like a buy or sell order, then I go on to MetaTrader 4 and actually manually come in here and actually place that buy or sell order. That's it. I'm just going to be using this to execute my trades and monitor my trades. And I'm just going to be using my trading view to actually analyze my charts. So yeah, that's how you actually use MetaTrader 4. And yeah, that's the full tutorial on MetaTrader 4. And then once you close the trade, I forgot to mention, once you close this trade, whatever trade that you close, you will come to this page history right here. And you can see the trade that you closed today, the trade that you closed in the past 1 week, and the trade that you closed in the past 1 month or so. Yeah, so yeah, this is basically a trade I just closed. You can see, closed, negative 0.04. And you can see the profit, you can see the, if you withdraw money, you can see the withdrawal right here and the other stuff that you can see right here, right? So balance, everything. So yeah, that's how you use MetaTrader 4, very, very simple to use. Today, I'm going to teach you how to become a successful trader who can bank consistent profits. My name is Brett Goh, and if you're wondering who the hell is this guy and why the hell should you trust this guy, here's what I've accomplished so far. I've been trading for 5 years and I've documented my entire trading journey on YouTube for you guys to see, or at least the past 3 years. So if you sort my videos back to the oldest, you will be able to see me live trading with less than $100 in my bank account and just basically documenting my entire trading journey. And my why when I started trading 5 years ago was that I wanted to retire my father, right, who was 65-year-old and still working very hard to put food on the table. And I'm glad to say that I've accomplished that goal, that big why, strong compelling why that allowed me to keep going this year, right? At the start of this year, I managed to retire him. So that will always be my proudest moment as a son. And then, yeah, like I said, I lost money for 2-3 years. So yeah, I'm going to be honest and transparent with you and tell you that I lost money, right? I didn't came out of my mom's womb and just became a profitable trader who is smart and intelligent. I was a dumbass. I made a bunch of mistakes. I lost over $10,000 in one day. I lost the school fees that my dad actually paid me. And I lost my life savings. Okay, I'm a dumbass, alright? So yeah, it might help for you to actually gain somewhat like a relatability to me, like you can relate. So I've been losing money for 2-3 years. Them are happy, they are successful, or rather they are making progress towards success. Over $25,000, somebody who made over $10,000, and Carl who made another $20,000 from his funded account. Crazy, these students are really crazy. Their success is my success. And I've built the fastest growing trading brand in the industry. Right? So if you look at my YouTube channel, just scroll down, you'll see that I'm near 1 million subscribers right now. Something that I'm very proud of because I built that shit brick by brick. And that's only because I was able to simplify complicated trading concepts that is so complex and stuff, so difficult to understand. I'm able to simplify them into a way that that is the main thing, that's the main reason why my channel blew up, right? And it's not because I'm the funniest guy. I'm not gonna lie, I'm a boring ass guy. And it's not because I have the flashiest lifestyle. It's all because of the fact that I'm able to provide tremendous amount of value, which is what I hope to do in this video. Last but not least, if it helps, I've got nothing to sell you. Alright, I've got nothing to sell you here. People who flex a lifestyle, you know, they flex their cars, their chains, their mansion in order to bait you into buying a course, right? I'm not the type of guru. What I am is a guy who's able to do everything he can to provide value for free and also to make sure that you guys learn what you need. In order to become successful. So I've got nothing to sell you here, right? I do have like an education company, 1% Club, but like I said, I'm not here to promote it whatsoever, right? In fact, I'm going to close the enrollment soon because customers, we want to focus on our current students. Alright, next. Here's basically proof that, you know, I know what I'm talking about. I know something about making money, right? Or I know something about trading, right? So at least I'm probably like 1 step ahead of you. I wouldn't say that I'm like 10 steps ahead of you. I'm a millionaire trader. No, because that's not the truth. The truth is I'm probably just 1 step ahead of you. I've pretty much just like figured some things out that you haven't figured it out yet. So yeah, I just hope to shorten your learning curve inside this video. Right, so what is the big promise for this video? The big promise for this video is that I'm going to show you how I went from $0 to my first $100,000. I'm going to tell you everything, a step-by-step blueprint on how I went from $0 to making my first $100K from trades. You have the attention span to watch this entire video, this journey that you're going to go through. I can shorten it from 3 years to say 1 year, right? If you genuinely learn everything inside this video and you apply what you have learned and you go out there and practice with enough time, you're going to reach this amount. Trust me, it's 100% possible. If such a dumb-ass Asian guy wearing this ugly-ass spectacles can do it, you can do it too, right? You can do it. So I'm going to dissect this entire process into 3 core components, right? 3 core components. The first one is strategy, right? So strategy, if you have a good and successful strategy, this journey is going to be much more easy. Is funding, right? Obviously, you need money in order to make money in trading, right? So you need to learn how to raise enough capital in order to reach this level, because it's very hard to reach 100k, right? Just like what I did when I started. And then last thing is something that is kind of cringe, heart or mindset, right? A lot of people don't like this stuff, but this stuff is the most important stuff ever, right? If you have this can pretty much outweigh all of this stuff right here. Alright, so yeah, without further ado, let's just dive straight into it. So let's talk about the first stuff, which is the strategy. I believe that you guys love this part, right? Strategy. And in this video, there won't be any charts whatsoever. If you go to my YouTube channel, you will see there's a ton of chart videos. So the truth is, you don't need any more chart videos. What you need is some real cold, hard, pure wisdom from the trading geek himself. Right, so first, let's talk about strategy. Okay, strategy. Now, what do you know about trading strategies out there, right? And just to name some right off the top of my head, you got price action, you got smart money concepts, you got ICT concepts, you got, I don't know, indicators, Bollinger Bands, MACD, lots of strategy out there. The question becomes, which one is the best and which one do you pick? My advice is always going to be so simple. Pick one. It doesn't matter which one you pick. You can become successful using any of these strategies here. We got successful price action traders, right? You got billionaire trading price action. You got smart money concepts traders who are banking through robot trades. You got ICT concepts absolutely killing the markets, right? And then you got people using indicators. Look at my face. I hate indicators. I'll always judge you if you use indicators. But we got people using indicators and still making money. Yeah, so even though I hate indicators, people are still making money using this stuff thing. So my advice would be stick one and go and master them. The last thing you want to do is to become a jack of all trades and a master of none. Right? What you want to do is to be extremely good, extremely proficient at one thing and one strategy only. So pick one and go and master them. Now if you're wondering which one is the one that I trade, before I erase this, what I trade is what I call market mechanics. Okay, market mechanics. Now this is a combination of money concepts, ICT concepts and price action. So for me, I trade all of this, but what I did was that I dissected, or rather I researched and I did a lot of testing on this to find out what is like the most profitable part of these strategies, and I combined them together to form market mechanics. And this is something that's unorthodox and has never been done before, but yeah, so that's what I did. And right now market mechanics is a trading strategy that is going to get me to making 7 figures from trading. Yeah. Because right now I've only made 6 figures from trading. In order for me to get to 7 figures, I needed to deploy market mechanics. So let's talk a little bit about market mechanics on why it's so profitable and why it's so useful. Alright, so let's say you do decide to go to the market mechanics route. There's an entire playlist of free courses on market mechanics on my market mechanics playlist. You can see the entire playlist of free courses. Quickly explain to you what is market mechanics and why is it so good. Right, so this is something that's out of the box. Market mechanics. This is essentially how the market operates. If you can really understand how the market operates, how and why price move on a deep fundamental level, you can print money. I'm not even joking right now. You can print money. Imagine you are able to trade alongside the smart money who move the market. Imagine you are able to go onto a blank chart and know exactly where the market is doing, what the market is doing right now, who is in control of price, supply or demand, and where is it going to go next. That is the power of market mechanics. And what does it constitute of? Right, so a strategy like market mechanics, it constitutes of a few core components. Firstly is your supply and demand. Right, supply and demand, this is where we identify certain point of interest, okay, that institutions have trade, or rather enter large amount of orders, right? Like example, this is the demand area, and now we are expecting price to come back down to this demand area, right? Because this is the price that they enter a large amount of order right here, right? They enter a lot of buy order, and now we are expecting price to pull back to this area, and that is when we can get our entry again, because this is the price point where they are going to enter again. So supply and demand, and then next is order blocks, right? So order blocks is a little bit like supply and demand, except that rather than just large bulk of orders, we are identifying like large amount of candlesticks like this, right? A lot of imbalance in price, right? A lot of orders being filled up at a short period of time, and that we have our order block, right? Which is like right here, right? This is the candlestick before the imbalance, and now same thing as supply and demand. You're just waiting for price to pull back, fill up all the imbalance right here, fill up all the orders right here, and then watch price move up. So these are two things. This is basically how we actually identify the point of interest that we want to trade from using this market mechanics strategy. And the next is liquidity, right? It is extremely important to understand liquidity, because liquidity is essentially how and why price move, right? If you can understand liquidity, you will not get stop loss money, and that means you will not get your trades, seeing your stop loss getting hit every single time. That's because you understand liquidity. Because if you can understand liquidity, then you will not become the liquidity itself. So yeah, liquidity is available above every swing high and below every swing low. And obviously there's a lot of like things about liquidity I'm not going to talk about in this video. Like I said, I've made an entire course on each one of these concepts right here, which you can find inside the free market mechanics playlist. And then next, it's also, I believe the one last thing is liquidity, supply and demand, order blocks. Is it inducements? No. Is this it? Inducements? Yeah, inducements is actually part of liquidity. It's basically like traps set by institutional traders, right? Traps set by institutional traders to actually bait retail traders to enter for the setup. Example, when you see this double top, right? A lot of retail traders think that, okay, this means that they should enter for sell. And then next thing you know, they enter for sell here, smart money push the price up, stop out all the retail traders, and then push price down. Inducements. And I just realized inducement is just a part of liquidity. Whoa! Market structure. How can I forget about this? Market structure is king, guys. Yeah, market structure is king. Market structure is basically essentially how the price move, right? In an uptrend or in a downtrend or in a consolidation. The ability to identify what phase of the market is it in? Is it the push phase, or is it the pullback phase? Is it the consolidation phase? Is it the trending phase? This allows us to know exactly which phase of the market is in right now, and then we can trade accordingly. And the last thing is order flow. Now, the last thing is order flow. This is basically where we dive deep into looking at how, or rather who is in control of price, whether the buyers or the sellers. And we do that by looking at footprint charts, and we do that by looking at what price is doing. Is it in the demand range, supply control of price? That's the main thing of order flow, right? So these are the 5 core components of market mechanics, and this is basically how I trade, right? Like I said, I've already made a video on each one of these concepts, which you can find in the free playlist. Yeah, so anyways, market mechanics. And then, okay, inducement is part of liquidity. I'm not a dumbass for actually writing this down. Yeah, right now I'm experiencing a little bit of brain fog, so yeah, just hit a heaviest gym workout, So yeah, that's for strategy, right? So now that you have figured out, okay, what strategy you want to trade, and you have picked one to actually go and master, you can about that strategy. Example, if you want to learn about market mechanics, go and watch the market mechanics playlist that I have on my YouTube channel. Like this entire playlist of like around in-depth, like I think 8 videos, in-depth video on each one of these concepts. Yeah, you will definitely master trading, and you don't even need to buy a course whatsoever. You can learn it for free on my YouTube channel. And that is for market mechanics. Oh yeah, basically after you're done with learning all that stuff, right? Next step is to practice, obviously, right? You have learned, you have practiced. But how do you actually know that this strategy actually works? That's the main thing that you need to do. And that is what I call testing. Right? So, after you have formed a trading strategy, you need to make sure that you can prove that the trading strategy actually works. Because if you don't, you will always be doubting yourself and your trading ability. When you go onto the market, you will not be able to enter for the buy or sell button because you don't build that confidence yet. You don't have confidence in your trading strategy yet.
And where do you build this confidence? Confidence comes from competence, right? And you're only able to build confidence in your trading plan if you have tested it out, right? So this is the key thing here. You gotta test your trading strategy out. There's 3 types of testing that you can do, and that's what I call back testing. Okay, back testing. And then another thing is what I call forward testing. And then the last thing is what I call chart exercises. Now, this allows you to know whether your trading strategy. By the way, you should do all of this for at least 1 month before you trade on a live account. Okay, at least 1 month. Go and backtest the trading strategy. So how you backtest is that you basically go to TradingView, you bar replay, right? You test out your trading strategy on historical price data, right? And then how you forward test is basically every single day you mark up your charts, right? You mark up your charts with the trading strategy, and then you basically trade on a demo account, or you just see whether your markups actually work. You know, you mark up your chart and you think that, okay, price is going to go up now. So the next day you check your charts again, see if price actually did go up. If it go up, then yeah, that's one win for you, right? So that's how you forward test. And then for back test is basically you test out your trading strategy based on historical price data. And chart exercises is pretty much you testing, or rather you marking up your charts on TradingView itself and then just seeing whether it's correct or not. So that's for testing, right? You need to spend at least 1 month doing this. I don't want you guys to go and trade your trading strategy on a live account, right? Very, very important here. A lot of you, what happened is that you come into trading with this mindset where you want to get rich as fast as possible. So what you do is that, okay, you have find your trading strategy, right? You have watched a bunch of trading videos, be it my videos or some other trading guru videos, and you found that, okay, this guy is driving a Lamborghini, and his trading strategy is obviously going to work, and it's free on YouTube. So I'm going to copy it and I'm going to put it on my live account. I'm going to test it out on my hard-earned money. Guys, how stupid is that? How stupid is that? Yeah, so you must test out the strategy first, right, to see whether it works. And if it does, then use it on a live account. If not, switch to another strategy, or rather refine your strategy until it works. So that's a very important thing, and I believe that's a process that most beginners skip, right? Because all of them, they just want to go straight from $0 to making, what, 10K per month, right? And they just skip the process between. And don't get me wrong, you can easily skip the process and still get to 10K per month, which means you don't have to test out your trading strategy. You can use the trading strategy and immediately you can get to 10K per month. Trust me, this is possible. But the thing is, are you able to maintain this 10K per month? Are you able to keep the profits that you have made? Because in trading, it's not about how much money you can make. It's about how much money you can keep. That's the main thing, right? So yeah, please go and test it out. And yeah, by the way, when I talk about trading strategy, I mean things like you need to take into account your risk management, right? Your risk management, right? How you actually manage your capital. And then I'm also talking about things like your entries. Okay, where do you enter for the trade, right? Where do you enter so that you can get like the lowest risk and the highest reward? And then where do you get out of the trades, right? And also things like your trading session, what time are you trading? And also what currency pairs are you trading? All of this stuff needs to be inside your trading plan. Needs to be part of your trading strategy for it to actually works. So just quickly, just think of all of this. Once again, I already did a video on how to actually do all of this, right? How to actually map out your mechanical trading plan. But yeah, that's for strategy, right? So like I said, the first thing you want to actually have is a profitable trading strategy. Because when you have a profitable trading strategy, guess what? Your trading journey is going to be so much more easier because you already have a strategy that is proven to work, that has already been back tested and forward tested, and now you have confidence in your trading strategy because you actually have trading data to back it up, right? So obviously you're going to be confident. Next is what I want to talk about, and that is funding. Now, in order to make 100K, in order to make 10K per month even, in order to make, let's say, $5,000 per month, you need funding, okay? You need funding, buddy. What this means is that right now, if you're a beginner, you probably only have like less than $1,000 in your bank account or something. Yeah, and you cannot afford to trade more than 10K, right? Let's say right now you can only trade 10K. Okay, so, oh my god, there's a magic button, magic pocket right here. Oop, wrong color, magic pocket. So, let's say right now you have 10K in your bank account or your trading account. Know that you can only make, let's say, $1,000 per month from trading with 10K. $1,000 per month. That's the most that you can make. If you are following proper risk management rules, like, risking 1% and all that stuff, the max is $1,000 per month, right? You cannot make more than that. So in order to make 100K, right? No, right here. In order to make 100K per year, right? Let's just do the math a little bit. 100K per year, that's at least like 10K per month, okay? Let's be a little bit conservative and just set it at 10K per month. So in order to make 100K per year, you need to make 10K per month. How do you make 10K per month? If you are only trading with $10,000. That means you have to flip your 10K to 10K and to 20K, I mean. And that's going to be very hard to sustain. I can guarantee you that if you try to flip your 10K to 20K, you cannot do that consistently. You cannot do that every single month. You cannot flip 20K to 40K and then 40K to 80K and then 100K. It's not that simple, right? Even though you have like a profitable trading strategy and by right, you are just going to win every trade. No, that's not how it works. Because trading is a probability game, right? It is a probability game where there's going to be a random distribution of wins and losses. So even though you have a profitable trading strategy, you are not going to win every single trade. You will still lose some trades. And you need to take into account of the losses, right? So in order to make 10K per month, I'll say a minimum amount of trading capital that you need to have is 100K. You need at least 100K to make 10K per month. And $10,000 of 100K is just 10%, right? So in order to make 10K per month, you need to make a return of 10% every single month. And I can tell you that is also quite difficult already, right? This is actually quite difficult. So to be even more conservative, by right, you should have 200K in trading capital in order to make 10K per month, right? But let's say, you are a genius, or rather you are better than the rest. You are able to make 10K per month. So let's talk about how to get this in funding. How do you get 100K even though you only have less than $1,000 in a bank account, less than 10K? You do that through prop firms, right? So prop firms are basically companies which offers you funding, and if you make a profit, they take a certain amount of profit, right? So there's a lot of prop firms out there, right? So there's a lot of prop firms out there. There is things like your FTMO, Alpha Capital Group, and then there's Funded Next. There's a lot of prop firms out there. I'm not going to tell you which. I'm not going to promote them or whatsoever. But what I would advise you to do is to just stick with FTMO, because this is the one that is the most trusted, the most reliable, and most reputable. And the others, I wouldn't say much about them because, yeah, this is just the best one. So if you had to choose one, I'll advise you to stick with FTMO. But FTMO is harder than the rest because you need to have it's going to be harder to pass the evaluation phase and the verification phase because you have like a higher target to actually aim for, right? But anyways, most trusted, most reputable, always go to FTMO. Now that you have, know exactly which prop firm that you want to use and you want to purchase like a 100K account, right? But like I said, do not do this straight away. You should have tested out your trading plan. You should have tested out your trading strategy and has some sort of proof that you have an edge. Because the last thing you want to do is to go immediately get a 100K account and you don't really know how to manage risk properly, and you end up breaking the rules and you lose the account and you lose the fee that you had to pay in order to get this account, right? So that's not the mindset to have. So like I said, I will advise you to only even get funded account like after 6 months of trading, at least 6 months. And it's very important that you actually test out your trading strategy. So 100K, let's say you want to make 100K from trading. Let's say you want to make 10K per month, right? So we are getting 100K to make 10K per month so that we can actually make 100K a year. Now, from this 100K, in order to even get this 100K, you have to pass through phase 1, and then phase 2, and then eventually then you get that 100K, right? After you pass through these 2 phases, right? And I'm not going to talk too much about the details on like the phases, the maximum drawdown, the profit target that you need to actually aim for in order to pass each of these phases. You can find them on the website itself. But what I'm going to do is that I'm just going to quickly give you like a quick strategy on how to manage your risk using this 100K. How do you manage this trading capital? Very simple, okay? Very, very simple. So let's say you start off with 100k. Okay, let me just erase all of that. Now it's time to do some math, ladies and gents, right? Because like I said, what you need is a very clear-cut plan in order to get to 10k per month. Okay, so let's say right now, today you have 100k in your trading capital. This is your initial account balance. This is the money that you start with. And your profit target is, let's say, 110k because you go to FTMO. So you need to make 10%. Okay? You need to make 10% in order to pass phase 1. Okay, that's for phase 1. Right? So, yeah, so your job is to make this 10%. How do you make 10% in 1 month? This is where my funding blueprint come in, right? This is the blueprint that I've actually discussed with my coach, and my coach has already given it to me. Or rather, no, not my coach. One of my colleagues inside 1% Club, and he's also coaching the students, right? So yeah, so this is a plan that he has been using to pass funding challenges, and it's also the plan that is really useful, right? I found that it's really useful. So I'm just gonna share with you guys for absolutely free. So start with 100k. So let's say you win a trade and you grow it to 100. Okay, let's assume that every single time you take a trade, you are risking 1, right? You are risking 1% on each trade. That means you are risking $1,000 on each trade. And assuming that your minimum risk to reward ratio is 1:3, because that's the one that you should aim for, right? 1:3 risk to reward ratio. That means if you risk 1%, you will make back 3% in return. Alright? A standard risk to reward ratio that you should all aim for. So if you are able to win the first trade, this 100k just became 103k. And then let's say you win the next trade. This 103k just become 106k. And then let's say you're still so lucky, you win another trade and you just turn this into 109k. And right now you're just $1,000 away from that goal, right? Which you can easily attain. This is if you are lucky enough to win 3 trades in a row, right? But obviously, this is not going to happen all the time, right? You must either have like a really good trading strategy, like a very high win rate, or you're somewhat lucky. Let's be honest, luck is going to play a part right here, right? Because like I said, trading is random. Okay, you lose. What happens if you lose? This is if you win. This is the best case scenario. What is the worst case scenario? Okay, this is where the strategy come in. The worst case scenario is that you lose 1%. Okay, you lose 1% and now you're back to 99k. You lose another 1%. Okay, you lose 2 trades already. Now you're back to 98k. Now, after your account dropped to 98k, right, and you already lose 2%, what I want you to do is to change this risk per trade, this 1% per trade, change it to 0.5% per trade. So instead of risking 1% on each trade, you're only going to risk 0.5% on each trade right now until you're able to get your account balance back to 100k. And then from 100k onwards, you can continue risking 1% per trade until you reach 110k. So that is the key strategy here in terms of passing your funding challenges, right? So let's say you lose another, okay, so you already 98k, right? Then you start to risk 0.5% per trade. So you lose another trade and you are down to 97.5k. And then you lose another trade and then you're down to 97k. Now, obviously, you're not going to lose like so many trades in a row. At some point of time, you're going to start winning. And when you start winning, what happens? You make 0.5 times 3, that's about 1.5%. So that is when, if you continue your 1:3 risk to ratio, you make 1.5%, you're able to bump up from here to 98.5k, and then slowly get back to this break even. Once you're back to your initial account balance, just continue doing the 1%. Change this back to risking 1% on each trade. And you do this until you reach 110k. You just risk 1% per trade and you get a 1:3, so you just need to win about 3 trades. Right? So in this case, in this strategy, right, you can see how you lost like 4 trades in a row. And then you win 3 trades. Or rather, no, 3 trades. 3 trades minimum, because you still have 1 more percent, right? So I'll say 3 to 4 trades. You win 3 trades, you lose 3 to 4 trades. And you just complete your phase 1. You just made 10%. And that is how you make 10k per month from trading, right? By using this strategy. And I understand that it might get a little bit confusing. So what I want you to do is that if you're unclear on this strategy, go and rewatch this part, right? Rewatch over and over again, take down notes and just test it out, right? Because trust me, this is a strategy that has gotten a lot of our students at 1% Club funded. And yeah, it's a strategy that one of the coach inside the 1% Club used to actually got multiple 5-figure payouts. So yeah, I can tell you that this actually works. So that's for funding, right? So that is basically how you achieve the funds in order to make 10K per month and in order to make 100K per year. Like I said, that is 10% per month, right? That is actually quite difficult to actually make. So the more amount of money that you have in your trading capital, the easier it will be for you to make, say, 10K per month or 100K per year, right? So I'll advise you to go for like a 200K account, right? That's more conservative when it comes to making 10K per year. I mean, 10K per month, because in that case, you only need to make about 5% per month instead of 10%, right? So that is for funding. Last thing I want to talk about, let me just find my green freaking marker. Freaking hell, I got one of the colors except for green. Okay, the last thing I'll talk about is the most important thing ever. And I know you're about to fall asleep right now, so get out on your feet and shake your hands and shake your belly or something and just slap yourself in the face and pay attention to what I'm about to say for the next few minutes or so, right? Like I said, I'm going to wrap it up very, very fast. This is about to end soon, so please don't fall asleep and listen to this. This is the most important thing ever, and that is your mindset. Now, Brad, why are you talking about mindset? Mindset, this is a trading video. Bro, this is what separates the bottom 99% of traders from the top 1%. If you can master this one thing, you will not just be able to bank consistent profits. You will be able to sustain in this game for the long term, right? That means that you are able to actually trade for the long term. 3 years, 5 years, however long you want to trade, you can only do that if you have a solid trading mindset. So let's talk about that. How do you develop a proper trading mindset? Or rather, how do you achieve your goals? First things first. First thing I want to talk about, okay, in this mindset training, I'm not going to talk about things like your trading psychology lesson that you've probably heard over and over again, like, if you are greedy, do this. If you are feeling FOMO, do this. Take some time off the charts, learn about trading psychology. I'm not going to talk about all those basic trading psychology advice. I'm going to talk about something that works, something that will actually allow you to open your eyes, and that is belief. Belief is the most important thing when it comes to achieving success. If you don't believe that you can succeed, what you will do is that you will not take the actions that will actually allow you to become successful. If you believe that you can become successful, you are automatically going to be taking the actions that is aligned with your goals, that's going to push you closer towards your goals and achieve success. So belief is the most important thing. And if you don't believe me, here's why belief is so important. Belief, when you believe something, you're going to do things that is in accordance with the belief, right? So that is going to lead to your actions, okay? So example, I believe that trading is difficult. So things that I'll do is that, okay, since trading is so difficult, I'm not going to bother study trading. Or even if I do study trading, I'm just going to half-ass it because it's difficult and it's literally designed for me to fail. So why bother working so hard on trading? Belief. Actions. Or I believe that risk management is pointless. Right? Risk management is pointless, it's useless. Why would you need to manage risk if you can just have a good trading strategy? You just need a good trading strategy. As a result, what happens next is that you don't use a position size calculator, big losses, and you quit trading because you just lost your entire life savings. Belief lead to action. You can see how important this is, and your actions actually leads to your reality. Right? So, in life right now, or in trading, is the result of all the decision, all the actions that you have taken. So you are 100% responsible of your life, your current situation right now. That means if you can change your belief, you can change your thoughts, you can change your actions, you can change your reality. This is something that not a single trading guru talk about. And I can tell you that this is the thing that is going to make my students unmatched. This is the things that is going to take my students who learn this become millionaires. I know for a fact that this will actually create millionaires. If you can really understand this loop, right? But the thing about changing your belief is hard. Because how a belief was formed in the first place, it's based on your experiences, right? So imagine there's a scale right here. Okay, there's a scale, and then there's a bucket right here. And this is a green bucket, and then this is, let's say, a red bucket, right? So this is the bucket of positive experiences, and this is the bucket of negative experiences. Okay, so positive experience bucket and negative experience bucket. every time you encounter a negative experience about something, you are adding more weight into the negative bucket. So this scale will start tipping to the negative experience. And when this happens, what you are doing is that you are forming a weak belief on that thing. Right? So example, let's say this is a scale on belief on how difficult trading is. Right? This is a scale on that is your belief on how difficult trading is. So example would be you start hearing your friends telling you that, Brad, you can't do it, man. Like trading is difficult. You know, only 1% of the people become successful. Or trading is a scam. It's only for those people who graduate from finance with fancy finance degrees and they work on Wall Street. Only they can become successful. You can't do it. So you hear your friends saying this. What happens is that you are adding water, adding weight into the negative experience bucket. And when you do that, what happens? The scale tips towards the negativity and you start thinking that trading is difficult. It is difficult. And what happens next is that your mind, it will seek evidence to reaffirm that belief. It's going to do everything it can to reaffirm this belief that trading is difficult. So that's the first experience that you encounter, the first negative experience. And now when you believe that trading is difficult, next thing you know, you pull up to the charts, you enter for a trade, anyhow, right? You don't have a plan whatsoever, just anyhow, just press the buy or sell button, and you lose the trade. When you lose the trade, what happens? Now, you reaffirm this belief. And you're adding more negative experience into the bucket. Now you really believe that, I just lost a trade. Is trading really difficult like what they say? Maybe I just suck at trading. Maybe I'm not born for trading. As a result, more negative experience. And you can see this scale just keep on tipping in the negative scale favor. And you will always have the belief that trading is difficult and you will eventually lose money and quit trading. This is the stuff that nobody talk about. I can guarantee you, if you're watching this far, it's only 14 minutes in, and you're still watching this, you deserve to know this. Because this is something that literally nobody talks about. And how you tip this scale back in the favor of the positive experience so that you can actually believe that, okay, trading is easy, it's doable, anybody can master trading as long as they put in the effort, they put in the time. They show up every single day, regardless of how they feel, show up to the best, and come hell or high water, they're going to do everything they can to achieve their trading goals. Boom, that's how you tip the scale to your favor. So how you tip the scale to your favor and really change that belief, it's by adding more positive experiences. Okay, here's the cool part, right? The thing about your mind is that it cannot differentiate what happens in your mind and what happens in reality. It cannot differentiate whatsoever. This is the cool part. This is the secret here, guys. So listen up. So this means when you have a nightmare, just think about the times that you have a nightmare and you woke up and then you start feeling your heart pumping very, very fast. Your palms are sweaty. This is because your mind perceives that nightmare as a real life event that you have encountered in the physical world. It does not know that it's just happening in your mind. It thinks that it is a physical, real-life event. What this means for you is that what you can do is to create positive experiences in your mind, right? Add these positive experiences in your mind in order to shift that belief about trading. And when you do that, what you're essentially doing right here is that you're just adding a bunch of positive experiences to strengthen your belief that you can succeed at trading. Trading is easy. Risk management is useful, right? You can really use this to fix any problem that you encounter in trading. Be it the false belief that you have of trading psychology is useless, this mindset trading is a bunch of bullshit. You can shift your belief back by doing this. And like I said, you can add positive experiences by using your mind. And what you can do is to visualize, right? Oh, visualization again is a bunch of bullcrap. No, let me tell you why visualization works. Because, like I said earlier, your mind cannot tell the difference between what happens in your mind, like a visualization or a memory in the past, then compared to something that happened in real life. That means you can think of a past memory, or you can think about a future thought or a visualization. Your mind is going to think that that's the same thing as what happened in real life. That's why when you think about your fear, like just close your eyes right now and think about something that you are genuinely scared of. Is it spiders or ghosts or I don't know, like something random, something that you are scared of? You start to feel your palms start getting a little bit sweaty, and you start to feel a little bit anxious. This is why this is so important. Your mind literally can't differentiate the difference between your past thought, visualization, or what happened in real life. So what I can do is visualize. When you visualize, your mind and body thinks that this has already happened. Right? This is your current reality. And this allows you to add more positive experiences inside the market. Example, you visualize trading is easy. You visualize yourself seeing MetaTrader 4 profits on your screen. You visualize yourself going to the charts and just executing a trade without any hesitation whatsoever. You visualize yourself marking up the charts within 10 minutes. When you do that, once again, what are you doing? You are adding positive experiences inside the positive bucket, and as a result, this scale is going to tip in favor of the positive experience bucket. So you're going to develop the belief that trading is easy. Trading is easy, right? Trading is actually simple, right? And when that happens, what happens next? When you have that strong belief that trading is easy, it goes to your mind. And then it results in you taking actions in accordance with your belief that trading is easy. You're gonna start that, okay, trading is easy, so I'm just gonna practice, show up every single day, do my best, right? Every single day, come hell or high water, I'm gonna do everything I can to achieve my goals because it is possible. I'm gonna create my trading plan, I'm gonna study the trading videos, I'm gonna practice on the charts, I'm gonna do my back testing, I'm gonna jump my trades. And when this happens, what you are doing is that you are getting better as a trader. You are improving as a trader. And when you improve as a trader, obviously, money comes as a byproduct, and this results in you having the reality that you desire, or by changing your belief. And you do that by having some sort of positive visualization, right? So this is not to say that, all you need to do is to sit there and say, I'm going to become a successful trader, I'm going to become a millionaire, and automatically that will happen. Like your bank account will just have $1 million inside the bank balance the next day after you just visualize. No, that's not how it works. Obviously, visualize, but you need to put in the work. You need to do the actions that is actually required in order to achieve your goals, in order to achieve your desired reality. That is why this part is as important as this part. You need both. You need good belief that result in great actions for you to achieve the goals that you want to achieve, be it 100K per year or 10K per month. And if you can really master this formula, you can make more than 100K per year. You can make more than millions of dollars. You can genuinely bend reality to your will. And let me tell you something. This is what most highly successful people do. Right? That's how they achieve so much success. That's how they make billions and millions of dollars. And it's all through this formula. This is the most important lesson you have to watch in the entire course. Because what separates professional traders who win consistently from beginner amateur traders who lose is the ability to trade based on clear defined rules. Basically, having a mechanical trading plan. So, in this lesson, we're going to go deep dive into building a mechanical trading plan that is not only profitable, but is actually tailored to your trading style, your trading personality, and basically your trading journey. So, quite frankly, if you are still losing money as a trader, you either don't have a mechanical trading plan, or you have one, but you are just not following it consistently. Or the third reason could be you just have a lousy one. So in this lesson, like I said, I'm going to go through how you guys can actually build a profitable one so that you can actually make money consistently. So this is basically how the majority actually trades, right? They are hesitate, to take a good trade setup because you just went through a losing streak. Your confidence is low, you're starting to doubt your trading ability, then you end up skipping a good trade setup, only to see it go in your way. When this happens, you start regretting not taking the setup. I should have entered for this trade. I knew it, I knew this would happen. After it has already played out successfully. Now, when you do this, you are basically what I call a hindsight trader, right? I should have done this. I should have entered for this trade. Oh my god, I knew this would happen. But guess what? I was too stupid
to not actually enter into the trade. Hindsight trading. And then this actually leads you into rushing into a bad trade, and you start forcing trades even though there's no trading opportunity, because you feel like trading, because you just missed a good trade setup, and you start to think to yourself, you know what, let me just go in to the next trade without really like thinking through it, because I already missed a good trade setup. I don't really want to miss another good trade setup. But then, make no mistakes, that is actually a bad trade setup because it's low quality, it's not based or rather aligned to your plan. And then you don't hold a trade to your take profit because you are afraid to lose your current profits, and then you succumb to emotions when you are trading because once again you do not have clear defined rules, and as a result you don't know exactly what you are looking for every single day. Now, this form of trading is called discretionary trading, where you are relying on your subjective judgment or gut feeling and the current market conditions to trade. So basically, you enter trades based on how you feel, right? You enter when you feel like it, you get out of the trade when you feel like, maybe the trade is not going to play out. You trade basically based on how you feel and your intuition. Once again, you will not make money consistently if you are always succumbing to your emotions when you are trading, because you will always end up missing good trade setups and just wasting your hard-earned money, your precious capital on just bad trade ideas. Now, once again, this is some characteristics for discretionary trading. Basically, you are relying on emotions and your gut feeling, and this actually allows you to take bad and low quality trade setups which really don't work at all. It's really not profitable. It's not going to make you any money whatsoever. And the thing is, it's very difficult for you to backtest and journal your trades when you are trading based on your emotions and you don't have like a clear defined trading approach. Because today you are trading this strategy, tomorrow you are trading this other strategy, and then the next day you are trading based on what you are feeling on that day. Oh, I feel like lucky today, I feel bullish today, so I'm going to enter for a buy. It's very hard to track your data in this way. And if you can't measure your trading performance, how are you going to improve your trading performance? How are you going to refine your edge? It's impossible for you to do so because in the first place, you are just trading randomly with 10,000 different trading strategies. So once again, do not do this. Do not be a discretionary trader. So the solution to this is another form of trading called your mechanical trading. Now, this is how the top 10% of traders are able to make money consistently. This is where you rely on a trading system to decide which trades to take, regardless of the market conditions or your emotions. Right? So in this case, you are able to identify high probability setups because once again, you are following or rather you are trading based on mechanical rules that's on paper. So if the market does this, you enter for the trade. If the market does not do this, you don't enter for the trade. You stay out of the market. Once again, a very, very clear rules-based approach. And it's much more easier to actually backtest and journal and track your data in this way because now you are able to record your trades in a way where, okay, if A happens, I'm going to enter for the trade. If B happens, I'm not going to enter for the trade. Now, when this happens, you are entering and exiting the trade the same way every single time. And this really allows you to find out what are your flaws in your trading strategy so they can improve on it. And this really, like I said, it allows that continuous refinement and improvement where you are able to continuously get better as a trader and as a result make more money. Now, when you go onto the market, or rather when the market opens, there's going to be thousands of decisions that you have to make in order to execute a trade properly. For example, where should you buy or sell? What price point is ideal for entry? Will you enter a limit order or a market order? How do you manage your open position? Where are you trailing your stop loss? How are you taking your partial profits? You see, there's all sorts of questions flooding your mind as you see the candlestick starting to play out. And when this happens, it's gonna be very confusing for you. And this increases the chances of you trading based on your emotion, based on your gut feeling alone. if you have clear defined rules in place for every single decision you have to make when you are trading, it will reduce the chances of you trading based on your emotions. In this way, the trading system decides which trades that you should take, regardless of how you feel or the current market conditions. Once again, just to make this clear, mechanical trading strategy will not completely get rid of your losses, meaning you will still lose money. But now, when you trade mechanically, you will suffer good losses because you are only taking trades that is aligned with your plan, right? And this way, you are able to treat these losses as business expenses because you follow your plan and the trade end up still didn't go in your way because trading is a probability game and the market is random. It is what it is. Move on to the next trade. Once again, when you are trading mechanically, you accept the fact that trading is a probability game and anything can happen in the markets. Now, this is a path, or rather a very dangerous path, a downward spiral that majority of traders tend to fall into, right? This is somewhat like a trap. Firstly, you trade based on your emotions, based on your gut feeling. So this is your discretionary trading strategy. When this happens, right, like I said, you trade based on emotions, you tend to take stupid trades, right? As the quote says, play stupid games, win stupid prizes. So you end up losing trades. Okay, when you lose trades, guess what? Your confidence drops. You start to doubt yourself. You start to doubt, does trading actually works? Like, can trading actually makes me money? Can I actually get rich from trading? And then this actually causes you to miss trade setups because when you're doubting yourself, your confidence is low. You're thinking, the chart is showing me this. I should enter for the trade. But guess what? Nah, I'm not gonna enter for the trade because I just went through a losing streak and I suck at trading. No, right? Then you end up missing the trade. And guess what? When you miss the trade tends to go in your way, and you sit there thinking, holy shit, I should have entered for the trade. Now, when this happens, you become once again a hindsight trader where you are regretting, oh my god, I should have entered for the trade. If only I entered for the trade, I would have made $500, I would have made $10,000. God damn it, I should have. And this causes you, once again, to revenge trade, right? Because when you miss a good trade setup, you tend to want to force trades, even though there's no opportunity. When this happens, you start revenge trading, you start entering into trades even though there's no opportunity whatsoever. You are purely trading based on your emotion. And we all know that is a recipe for disaster. And this causes you to lose trades, lose money. And then if you go back to trading a discretionary trading strategy, which means you're still trading based on your gut feeling and your emotion, this cycle will happen over and over again. The sooner you become aware of this entire cycle, this entire trap, the sooner you can get out of it. And then the sooner you can actually become consistently profitable. So, like I said, this is literally how the majority trade, how the 90%, the bottom 90% operate. Once again, these are the people that is giving their hard-earned money into the market. And you watching this, it's your job to take their hard-earned money. And that is why I want to present you the path to success, right? So, once again, the path to failure is a discretionary trading strategy where you are trading based on emotions, guesswork, or your gut feeling, intuition, whatsoever. The path to success, we are utilizing a mechanical trading strategy. Because when you have clear defined rules in place that tell you exactly what you need to look out for on the charts, what are the trade setups that you should look out for, what is your entry criteria, how should you exit the trade. All of these decisions are answered based on rules inside your mechanical plan. And when this happens, like I said, if this trade setup fulfills all the criteria in our plan, we enter for the trade. If it does not, we stay off the market. As this happens, as time passes, you record your data, and now you have sufficient data in order to back up your edge. Right? When you back up your edge, guess what? This give you confidence. Competence leads to confidence. When you build up that confidence, or rather when you build up that solid data, like you are winning this amount of trades, your win rate is 60%, you have cold hard data, numbers that tell you that your trading strategy is actually profitable. Guess what this does to your self-image? It makes you feel confident. It makes you feel like you can actually become profitable. And like I said, these are all raw data that allows you to back up your edge and makes you feel confident. And when this happens, the market tends to go in your way, right? Or rather, luck should be on your side. And then you master the mental game of trading. You are able to figure out how to control your emotions, not really completely control, but rather like how to manage your emotions properly so that you don't let them take control of you, and you start trading in a robotic way. And this actually leads you to consistent results, right? Consistent results where you're actually making money consistently, and this is when you can potentially think about scaling your capital, taking your trading to the next level, and that is when you become a top 1% trader, outlier. Now, once again, this is the fundamental law. Remember, you cannot control what the market is going to do or how much money you are going to make. There is only one thing within your control, and that is yourself. You can control where to enter and exit the trade, how much money to risk on each trade, how you manage your floating positions. And by having a mechanical trading strategy, you will be able to become more consistent with your trading, with your actions, and as a result, get consistent results and make consistent profits. Now, a good trading strategy, in my opinion, is not 100% mechanical or 100% discretionary. Oh, god damn it, so hard to pronounce this thing. A profitable trading strategy is 90% mechanical and 10% discretionary, which means you will still need to rely on your human judgment and emotions sometimes, because the markets are always evolving. And this is why majority of the trading robots or algorithms fail, because the markets will always evolve, and you need to continuously tweak and refine your trading plan to suit the new market conditions, right? So adapt or die. In order to build a mechanical trading plan, you need to have these 4 things in place. Firstly, entry criteria. Secondly, exit rules. Thirdly, trade management. And fourthly, your risk management. When you have all 4 of this is when you are able to get a complete mechanical trading plan that tell you exactly what you should do from the start of the trading day to the end of your trading day. So now let's go through one by one. Firstly, entry criteria. As much as possible, try to stick to your entry rules. That means if the setup checks all the criteria, all the entry criteria, then enter without any hesitation. If not, stay out of the market and look for other trading opportunity. So make sure you enter the same way consistently so that you don't end up missing good trade setups and you actually avoid low quality trade setups. So you need to define these things. How do you map your market structure? Are you using the 4-hour time frame? Are you using the daily time frame to actually map out your market structure, your bullish break of structure, your bearish break of structure, your market shift, whether price is in a pullback phase or the push phase? How are you doing this? What time frames are you going to be entering the trade on? Once again, this depends on what type of trader you are. Be it a scalper who's entering on the trade on like the 1 minute time frame or the 5 minute time frame, and then a swing trader could be entering the trade on the 1 hour or the 4-hour time frame. Completely depends on your trading style. And then, does the point of interest that you are entering the trade on need to sweep liquidity? Because by now you should understand that we only enter the trade when price is at a point of interest. We don't enter when price is in the middle of nowhere. We enter when price reach either a supply or demand zone. And when that happens, or order block, and when that happens, you need to ask yourself, does this point of interest that price actually reach need to sweep liquidity or not? Is it part of my entry criteria? So if it needs to sweep liquidity, then I will only enter for the trade at a sweep zone. If it doesn't sweep liquidity, then I'm perfectly fine with entering the trade on a supply-demand zone or an order block that have no liquidity sweep whatsoever. And where are you actually entering the trade on? Right? You need to be very specific when it comes to this. You cannot just do it based on guesswork or based on your feeling or basically what you're feeling at that point of time. Right? You need to think about, okay, are you entering on the edge of the zone? Basically when price touches it, or are you entering at the equilibrium, the 50% of the zone, or the extreme end of the zone? And also, what are the confluences are you looking out for? Are you looking out for inducements? Your push and pull inducements. Are you looking for liquidity, price to sweep either the buy side liquidity or the sell side liquidity? Are you waiting for your market shift to happen? That shift of order flow, that shift of structural. What are you looking for? What is your entry trigger? So make sure you write down every single detail and leave no stone unturned. To make this strategy as mechanical as possible so that you know exactly what you are looking out for when you go on to the charts. Next is your exit rules. For your exit rules, you want to define exactly where you will get out if your trade does not go as planned, and also where you will get out if the trade does go in your way. So once again, same thing with entries. You want to exit the same way consistently so you don't end up cutting your winning trades early and you maintain consistent risk. So there's two types of exits, right? One if the trade does not go as planned, and one if the trade go as planned. So your stop loss placement, this is where you think about, okay, you want to be placing your stop loss behind your supply on demand zone or behind your swing high or low, right? And when that happens, how many pips are you placing it behind the S&D zone, behind that swing high or low? Could it be 2 pips, 3 pips, 5 pips, or 10 pips? How many pips are you actually placing your stop loss distance? And then you need to define how many pips your stop loss should be, right? And once again, the minimum is 2 pips because you have to take into account the spread from your brokers as well. Next, for your take profit placement, you need to decide whether you want to place your take profit based on a fixed R method, which means if price reaches 1:3R or 1:4R or 1:6R, you get out of the trade no matter where price is or no matter what price is going to do, right? You just completely get out and respect your R multiple. Or you are placing your take profit based on technical targets, right? Okay, it's quite subjective, right? You're exiting the trade at the next supply or demand zone or the next swing high or low. Define your exit rules, because when you set your exit rules properly, you will not regret when price blows past your take profits, because you know for a fact that you are following your plan. And then if the price does hit your stop loss and end up going in your way, guess what? You will know that next time you need to make your stop loss wider and give it more breathing room. This way, you will be able to continuously tweak and optimize your trading plan while maintaining consistency in execution. Now, for trade management, once again, you want to manage your trades the same way every single time, because when you are consistent in managing your trades, your trading account tend to have like a steady growth, like an uptrend growth, rather than going through constant up, down, up, down, up, down, up, down. So you need to take into account the following thing. What trade management method are you using? The set and forget method, or the trading stop loss, or partial profits? Where are you taking partials? And if you're taking partials, how much volume are you removing from the position? And when will you start trading your stop loss? How many pips behind the swing high or low will you be trading? And what time frames are your stop loss and take profit on? You need to take into account all of these things and think about how do you actually manage your open position properly, so that you don't really leave it up all to your emotions. Oh, I feel like taking partial profits today, so I'm going to do that. Oh, I feel like moving my stop loss today, so I should do that. So no, you are just, once again, relying on your emotions. You need a clear rule-based approach. Risk management. So once again, you want to follow strict risk management rules consistently every single time you take a trade, because this actually determines how long you are able to stay in this game. Because remember, you cannot play if you run out of chips. If you run out of money to trade with, guess what? You can't trade and you can't make money. So capital preservation is really the most important thing ever, which is really, it should be one of your main focus. This part right here could be one of the most important part of this mechanical trading plan. So you need to include these things. How much money are you risking per trade? Is it 1% or 2%? And then your position sizing. So for this, you usually go to your position size calculator after you were able to determine your risk per trade and your stop loss distance. Just go to the calculator and just input everything there, and the calculator will do it for you. And how much money are you risking if you are planning to scale in? Because on the first trade you could have scaled, or rather on the first trade you could have entered for 1%, you could have risked 1%. And then if you want to scale in for another trade, the second trade, how much are you risking this time? Is it still 1%, or is it 0.5%, or is it 2% even, right? Think about this. And what's the maximum account exposure you are willing to accept? Right, the maximum amount of drawdown you are willing to accept before you decided that this is it. And the max daily loss before you stop trading for the day. Once again, this is very important because this actually prevents you from over trading and actually lose even more money if you are encountering a losing streak. So always just remember this. When you execute a mechanical trade plan that is clearly defined consistently, you will no longer need to rely on emotion or guesswork whatsoever. All you have to do right now is to follow the rules laid out and actually execute them in real time. If there is a trade setup that fulfills your entry criteria and you actually enter into the trade, guess what? Utilize the exit rules, the risk management and the trade management part to actually think about how to manage that position. If there isn't a trading opportunity whatsoever, you stay out of the market. As simple as that. Once again, if it's difficult for you to stay out of the market, just always remember, capital preservation is key. Your focus is not to make money. Your focus is to protect your capital. And then the second focus then is to make money. But once again, remember, you cannot play if you run out of chips. So only when you have a mechanical strategy, you will be able to identify the flaws and shortcomings of your strategy so that you can continuously tweak and refine it, and as a result, your win rate will increase. So ladies and gents, just always remember, consistent action leads to consistent results. If you are consistent in terms of how you trade, day in, day out, the profits will eventually come. Right, it will eventually come. I know for a fact that it will. The opportunity will present itself, and when it does, you execute it without any hesitation, and you win, you make money, and that's how you do it. That's how you do it, by having clear mechanical rules in your plan. So now that we have established that market structure is the most important thing ever and it lays the foundation for our mechanical trading strategy, let's go deep dive into market structure, right? But first you have to understand the basics. Now when you really look at the markets and how it moves and you think from the first principles, it all comes down to these three ways, right? The market can only move in these three ways. Meaning, it can either go up, or go down, or go sideways. That means it cannot go zigzag or whatever that you're thinking of, right? Let's keep things simple, right? Basically, the market can only go up, down, or sideways. And when it goes up, it's not going to go up in a straight line like this, right? That's not how the markets work, right? And when it go down, it's not going to go down in a straight line like this. It's going to go up, pull back a little bit, go up, pull back a little bit, go up, pull back a little bit before going up even further. Why does this happen? Because it's essentially like a car, right? Let's say you are a car and you are going to your destination. At some point of time, you're going to run out of fuel. And then you need to stop at a gas station to get more fuel. That's essentially the same thing as the market, right? So the buyers, when they push the price up, at some point of time, there's not going to be enough buyer to continue or rather sustain this upwards momentum. And that is when price will pull back, so that, the price of the asset can get to a much more better price at a discount, and then that is when more buyers will jump in and push the price up even further. And then this cycle just repeat over and over again, right? And this is basically just how the market moves, right? If you can really understand this, this is it. Yeah, this is basically how you make sense of the market. But obviously, like I said, it's not going to be this easy, right? Right now, look at this. This looks like just simple chart diagrams straight out of the textbook. This is like the utopia perfect downtrend, uptrend diagram. And this is just not what the market looks like. Here's what the market actually looks like, right? So this is your expectation and this is your reality. Now, let's seek to understand bullish and bearish market structure even further. First of all, let's look at bullish market structure. So like I said earlier, price will never just go up in a straight line like this, right? It will not just go up like this, like in a rocket style. No, it has to go up, pull back, and go up even further. And this is what we call market structure, right? It's the structure of the market. It's the DNA of the market. It's basically how and why price move, right? So how price works is that price will push up like this, create an impulse, and then start pulling back, and then creates another impulse. Now, when it does this, right, what it does is that it creates this swing high and then it creates this swing low. Now this low is only validated after it led to a break of structure, when price actually goes up and break the last swing high. Okay, let me repeat myself, this is very important. This can only be considered as a valid swing low if it goes up and break the last swing high, creating your break of structure. So what this means is that after price breaks structure and creates a new high, this high is higher than the previous high. And now we are expecting price to pull back again. Because like I said, you cannot expect price to just continuously going up like this after it just break through the last high, right? At some point of time, it needs to stop and it needs to rest and it needs to pull back so that more buyers will jump in onto this uptrend, this bullish market structure. So that is what we are anticipating, right? So I want you to remember this. Whenever price creates a break of structure, expect a pullback. Anticipate a pullback to happen soon, right? And a lot of retail traders, what they do is that after price create this break of structure, they continue to buy, right? They continue to buy thinking that this upwards momentum is going to continue forever. And I hate to break it to you, buddy, but eventually price is going to start pulling back, right? And there is nothing wrong with buying after price break structure, but it's just that you can buy at a much better price point, right? At all of these higher lows. So after price creates this break of structure, it forms this new higher high, and then that is when we can anticipate price to pull back. And when pull back, it's going to pull back to create a new low, a new swing low that is higher than the previous swing low. And then it goes up again, creating another break of structure, breaking past the last higher high, and then create another higher high and higher low. So this is basically how an uptrend is formed. An uptrend, a bullish market structure, whatever you like to call it, is formed when price is creating higher highs and higher lows. Higher highs and higher lows. Bullish market structure. Alright, so in a downtrend, it will look like this, right? It's the opposite of an uptrend. So price will goes down, pulls back, create a new high before price goes down, break through the last swing low, creating your bearish break of structure, and then that is when we are anticipate price to start pulling back again, right? And then that is when price start pulling back again, creating another lower high, and then it goes down even further to create another lower low, right? So in a downtrend, price will be making your lower high and lower low. And remember, guys, this lower high can only be considered as a valid lower high after it has led to a break of structure. Okay, after it has led to a break of structure. So the key here is that it needs to break structure, right? In order for this to be considered as a valid high. And in order for this to be considered as a valid low, a valid swing low, it needs to break structure. Alright, so get that through your head. So by now you should know that a bullish market structure is price creating higher highs and higher lows, and bearish market structure is where price is creating lower highs and lower lows. Like I said, obviously, this is not what the market will actually look like. Sometimes it will look like that, maybe like 5% of the time, to be completely honest with you, right? Most of the time, the market looks like this, right? It looks like a gigantic mess, right? And when you look at this, right, I always want you to really think about where are the swing highs and where are the swing lows. Because if you can identify that, then you can make sense of the market structure and you can determine whether price is bullish or bearish, right? So let's go through the real graph, right? So over here, this is when price, once again, push up and then pulls back and then push up. After price push up and break through the last high, creating a break of structure, what it did is that it created a minor pullback, okay? A minor pullback, not a significant pullback yet. So after that, price just continued going up even higher before price starts creating a major pullback. Now, once this major pullback happened, this is the last swing high, okay? Not this one right here. It will be this one right here because this is the last high, the highest point before price starts pulling back. Okay, and then that is when price starts pulling back and it starts creating this bearish move a little bit, right? Because price is going to turn bearish after, price is going to turn bearish when it's pulling back, right? In order to facilitate that pullback, right? And then that is when price goes down here and then it creates a new higher low right here before price goes up even further and yeah, eventually break the last swing high, creating a break of structure. So in this case, bear in mind that the higher low will be the low that led to this break of structure. So that means it will not be this one right here, it will not be this one right here, but the lowest point, okay? The lowest point that led to the break of structure. And then that led to price creating another higher high, higher low, and then another higher high, right? And then in a downtrend, this is when price goes down, pull back, goes down, and then starts pulling back heavily. And that is when price creates another lower high before price goes down again and creates another bearish break of structure, right? Breaking past the last lower low, leaving us your lower high right here, the highest point before price goes down and break structure. And then it led to a lower low and lower high again, right? And then just continue going down, continuing this bearish market structure, right? So basically right now, for now, you just need to understand that bullish market structure, higher high, higher low. Bearish market structure, lower high, lower low. And then we are expecting a pullback whenever price breaks structure. So after price breaks structure, you are anticipating a pullback. And the pullback means what? That means the market is going to go against the swing trend for a short amount of time in order to facilitate that pullback, right? So in this case, since it's the uptrend, that means the market, when it's pulling back, is going to go into like this minor downtrend, right? To facilitate the pullback before the uptrend continue again and go up even further. Same thing with the downtrend. Since the overall trend is downtrend, right? The market is going to turn bullish for a short amount of time to facilitate the pullback before going down even further, right? So next, let's talk about swing highs and swing lows. How do you determine which one are the valid swing highs and which one are the valid swing lows? Okay, very simple. You always want to look for the highest point that the lowest point that creates the break of structure and lead to a swing high, and that will be your swing low in a bullish market structure. And then in a bearish market structure, you always want to look for the swing high, which is the highest point that creates break of structure and lead to a swing low. Let me show you some examples, right, to help you get a better understanding. And then this is when, once again, price push up, pull back, and then goes up like this. All right. So this is obviously a swing high. This is obviously the swing low. And then that is when price goes up, make a minor pullback, and then goes up even further. Right. So at this point of time, price has not made a significant pullback yet. Right. It has not made a significant pullback to create a new swing low yet. So we still wait. We wait until price starts giving us a significant pullback like this. Right. Price goes bearish to facilitate that pullback. Right. And goes all the way down here. Now, after this, look at what happened next. Price reverse and goes up, and then led to a break of structure. So you just need to identify the lowest point that creates this break of structure that led to this swing high being broken, right? And if you look at the lowest point, it will not be this one right here because there's a lower point. And it's not this one as well because there is an even lower point. And it will be this one right here. This will be the lowest point that actually led to this swing high being broken, right? And then led to a new high being created right here. So this is your swing low. Okay, so if you need help when it comes to identifying this, right, just use the box tool on TradingView, right? Just click right here, box tool. You just mark up the higher high, right? The one that just got broken. Drag it out like this and then pull all the way down to the lowest point, okay, the lowest point of price, and you'll be this one right here. So there you have it. You will be able to find your higher low, your swing low right there. And then that is when price goes up even further, right, creates a new higher high and then starts pulling back, pulls back and create another lower high, right? This is to facilitate the pullback, right? It's going to turn bearish to facilitate the pullback before price goes down even lower, creating a new swing low before price goes up and breaks structure. So same thing. At this point of time, you're asking yourself, okay, since price just broke this last swing high, what is the lowest point that price went to that led to this break of structure? So you can use this box tool method, right? Drag it out and go all the way down to the lowest point, and you will see it's this one right here. This will be the swing low. That means you must go all the way down to the lowest point, not this one right here, guys. The lowest point that led to the break of structure. So that is how you're identifying your swing low and swing high in a bullish market structure. Now, in a bearish market structure, it's pretty much the same thing, right? Price goes down, led to a break of structure, and then it starts pulling back, right? We are anticipating the pullback. And then once price starts pulling back, pulls back all the way up here before price goes down even further. And then price goes down even further, break through the last low, right? Break through the last low, creating a bearish break of structure. So at this point of time, you're asking yourself, what is the highest point that created this break of structure and led to another swing low being formed right here, right? That led to price breaking past this last low, right? So you can use the box method. This time, drag up, find the highest point that led to this break of structure, and you'll be this one right here.